Hello, ooh, that's loud. Let me turn that down a bit. Hi, everybody. It's Lawrence from FinancialThing.com. Back on a Thursday. I have to keep you guys on your toes and girls. My schedule's kind of been a little bit all over the place, so I think I'm going to be doing Saturday streaming, but this week it happened to be Thursday availability, so thank you for being flexible. And if you're watching this on catch up, welcome. Thanks for joining. Hope you're doing well. I tell you what, it's a weird time in the financial markets right now. Everything has been sort of flat, and then up a little bit, down a little bit. I've been getting quite a few emails about what do I think is going on with the financial markets. I have no idea. They are very bipolar. Things are weird at the moment. So wait and see. Watch and learn, I say. That's what I'm doing right now. I'm watching, I'm learning. Learning as I get older, too. Got some new lighting. Can you see any difference? Does it look better? Because I got it switched over from a iMac to a different computer, so I hope everything is working well. And yeah, good to be back on a Thursday. Thursday is not always convenient now, schedule-wise, but for this week, it is. So anyway, we're going to be talking about a little bit of peer-to-peer lending news, what is going on with my allocations, what I feel about LoanPad. We'll do a little bit of peer-to-peer lending news, not too much in the news over the last couple of weeks. I'm going to show you a trading 212 portfolio snapshot, a swing trade that I took this week, which has been a big fail. Another warning why trading is really a bad idea. Case in point, I'm going to show you how much I'm down on a trade. Thankfully, not a huge, because I took a small trade position, but I'm going to show you what I did, how I screwed up. Because we're all about transparency here. I'm not claiming to be an expert when it comes to this stuff. I think as long as I can get 51 out of 100 right, and technically that would be okay if they were all the same trade sizes, but we'll see. And we're going to talk about some consumer financial news, a couple of interesting emails that came through over the last couple of weeks from the mailbag that I think are really great topics of conversation. So glad you're enjoying the lighting. Thank you. Holly, of course, is here. She's taking a good snooze right now, and hopefully she can learn something about finances. Yeah, I think that the lighting looks good. Have I gone over to the dark side on the computing? Absolutely not. No, I'm a Mac guy. I've been a Mac guy for a long time. So I actually bought a Mac Mini, which is a tiny little computer. It fits in literally the palm of your hands. My old computer was an iMac, big old thing. So I got this Mac Mini, and I tell you what, it's probably been one of the best computers I've ever owned. Small, it's quiet, doesn't get hot, and it's cheap. And it's way faster than I think any computer I've ever owned. So yeah, very good purchase. And I think it's a business write-off too. So anyway, if you could hit that thumbs up, I would really appreciate it. It helps the channel out a lot. And if you're not subscribed, please do so. Subscribe to this YouTube show, if it's a show. I don't know what it is right now. It's rambling. I call it YouTube rambling. Anyway, let us say a quick hello to everybody who's in the chat. Dave Ellard is up first. Evening, Dave Ellard. Thanks for joining. Peter Vincent, a very wet and mild Leatherhead. It's actually today, speaking of weather, here in Orlando, Florida, I think the conversion would be about 10 degrees maybe. So it's pretty chilly, having some nice cool winter weather. Aki Chap is here, of course. Good to see the Trotters are still sponsoring the channel. I know, it's so nice of Del Boy to do that. Paul New is here. Hi, Paul. Hi, Paul. And Alice Stratford is here. Mike Palace here. Paul Bagworth from Kenilworth. Dave Dawson is here. And yes, the computer is efficient, if that's what efficient. efficient. I don't know. I don't even know what efficient means. Not being an educated scholar that I am, efficient. Achieving maximum productivity with minimum wasted effort or expense. Fluorescent lights. Yes, well, I guess that's a good word, efficient. I like it. I like efficient. Word of the day. It's good to learn new things. Anyway, let's crack into it, okay? Don't need to convert. We speak Fahrenheit over here. Is that right? I didn't think that... I know when I was growing up, I didn't really understand Fahrenheit, but Fahrenheit, I think it's about 60 degrees Fahrenheit, so it's very nice that it's sunny. A little bit of clouds, but nice. Anyway, let's get into it. It's not going to be a long stream today or this evening because I don't have too much to talk about, but I always say that and we end up going an hour. So there you go. Here we go. Let us get into this. This is LoanPad. Quick look at the dashboard. I think I checked this about 10 days ago and it seems to almost be exactly the same. Not really much movement with the lenders, not much movement with the loan value. Average loan size is about the same. Yeah, it hasn't really moved much at all. The reason I'm keeping an eye on this too is I will be transparent and tell you that my biggest position in peer-to-peer lending right now is with LoanPad. So yeah, I was thinking about the Blend network situation and I did some research and I reached out to some people I know, and it seems to be like cash drag is the biggest issue with Blend, and I decided to just kind of sit tight with that at the moment and try just to put some more money into LoanPad for now as kind of a holding place. I do like, one thing I really like about LoanPad is being able to see your interest being paid every day. And it's a really stupid thing because I don't have hundreds of thousands of pounds in here. I mean, I think I'm getting about, £1.73 in interest a day. So for all of you smart people out there, you'll be able to calculate how much I'm holding actually in LoanPad at the moment. But I do like being able to log in and see that interest being paid daily, and it's a mental win, and I think it's really cool. So I did hold off on Blend for now due to the cash drag concerns that I have, and have gone more heavy into LoanPad. We'll see, that may change. Part of that too is just not having time to really keep up on multiple different accounts. I really tried to keep accounts manageable. Right now, I've got about 5 or 6 different active peer-to-peer lending accounts that are all of them on auto lend, and some balances smaller than other. But I got to tell you, I've been very, very happy with LoanPad, and even just the other ones I've been invested through, and it hasn't changed at all. I mean, it's Cufflink, Unbolted. Cufflink, I'm on the 1-year product. Unbolted, auto lend. LoanPad, Crowd Property. Again, more of a concern, I would say, out of all of them. That would be my biggest concern with the peer-to-peer side of what's going on with their defaults. But, we'll see if this new CEO takeover makes improvements to that. And Cufflink. So I think that's the 4, right? 4 main ones. I'm trying to think about the other one. I have another one too. But those are the 4 main ones right now, and heavy dominance, I would say, LoanPad and Crowd Property, Cufflink about the same holdings, and Unbolted a little bit more than those two. So I think there's definitely some good opportunities out there in Pittsburgh. It's always about what risk you're willing to take and how much you want to put of your liquid assets into this product of lending. So right now I'm at a comfortable level. It's actually the highest that I've ever had invested in peer-to-peer is happening this year, which is unusual because I didn't think that was going to happen. I thought it was going to kind of relatively remain the same as last year, but things do change. So that's what's going on. We'll do a little bit of news. Mainly European peer-to-peer lending news right now. Estate Guru warns of losses on German real estate portfolio. This is a good warning to everybody out there who has not experienced any losses. That losses do happen when it comes to peer-to-peer lending, and some of our Estonian Estate Guru company investors are finding out that their loans on the German real estate portfolio have been underperforming. Said in an update to investors, the European P2P platform said it's been using its own capital to offset defaults, but ongoing difficulties in the German real estate market mean that losses are likely. So they're going to pass those losses on to investors. In January 2023, Estate Guru paused all new lending in Germany while the platform addressed the underperformance of the German segment of its portfolio. This was caused by slowing transaction in the German housing market, as well as regulatory uncertainty and cost pressures within the property development sector. While the market picked up again in 2024, Estate Guru noted this was only very slowly and not in all regions. For property owners in shrinking regions, falling demand and declining rental income could pose a serious financial risk. As a result, we anticipate an increase in properties being sold below historical market prices, and as a result of oversupply. Each month we allocate approximately 100,000 euros of our own capital towards default recoveries, bringing our total contribution to over 1.1 million euros in 2024. That said, the firm anticipates that more recoveries will take place in 2025. The exact proportion of the portfolio affected will depend on the resolution of ongoing enforcement and insolvency proceedings. So not great news for Estate Guru investors who have put money into these German loans, and really a sort of an indication of what's going on maybe in the German housing market over there. I don't really study the European housing market too much because it doesn't really affect the UK peer-to-peer lending side of things. But if you are a European investor, it's good to know that, losses are certainly possible, and in different countries, there's different risk involved when you're buying property peer-to-peer lending loans. There's companies out there like Mintos and Bondora that are offering peer-to-peer loans in different countries on real estate. Well, sometimes they pay really juicy interest rates. I've seen them 20, 25%. There does come risk along with that. Of course, if you want to get paid those high interest rates, those high returns and yields, you're going to have to take risk. But just be prepared that those risks don't always turn out well. So diversification is absolutely the key. Make sure you stay diversified. And then, second story coming out of the Euro peer-to-peer news, that investors are expecting returns of 10.64% for 2025. This is RoboCash platform research. They always put out a lot of reports like this, saying the range of investor estimates varies from 10 to 12%, suggesting that the market is on a conditional plateau in yields. Did I say that right? Plateau. Among the respondents, 35% have been investing in peer-to-peer for 4 to 5 years, while 30% have been invested for more than 5 years. It highlights a good level of engagement among investors, said RoboCash. This experience can be crucial as it illustrates that many individuals have navigated various market conditions. 35% of people say they expect the market to remain stable. 26% believe yields will decline moderately. I think that makes sense. When we're in a cycle of interest rate cuts, the yields would have to decline, so that makes sense. On average, respondents expect about 10.64% returns from peer-to-peer in 2025, and the optimal rate range of 10 to 12% suggests that investors prioritize reliability over high returns. One must remember that the survey involved only is for a sample of investors and not the general population. So, 12% on the high range is a very, very high yield to be getting in any type of investment. Even though we've seen the S&P 500 make crazy stupid returns over the last couple of years in the 20s range. 10 to 12% is still very high. So again, if you're investing looking for that type of return, just always keep an eye on the risk involved in making those types of investments, because it's really not a normal return rate. I would say, for UK property investments through peer-to-peer lending, you're probably looking around 8.5% would be an average. So getting 10 to 12 is much higher, probably involves more risk. Platform update. For those of you who are Relendex investors, I am not myself, but I do get their updates. They sent one out on Feb 20th, so that was today. And I haven't read through this totally, so I thought I would do it live in case you are a Relendex investor. But it says Relendex is slowly evolving from our original concept of providing a universal platform to retail investors of all sizes to an ever more sophisticated specialist real estate debt lender model managing our investors' portfolios. Investors who have joined Farringdon Portfolio are already experiencing enhanced portfolio diversification, minimized cash drag, and the advantage of securing allocations in sought-after loans that would often fill within minutes, sometimes under 30 seconds. This does not mean that Farringdon Portfolio clients are prioritized. They are not. It just means that our team have to be quick off the mark to bid on our clients' behalf. It also means fairer allocations of the most sought-after loans. So I'm imagining, again, I haven't looked into this, but Farringdon Portfolio is some kind of a managed portfolio where Relendex is buying pieces of that for their clients, maybe. Are you in that? Anybody out there investing in this Farringdon Portfolio? Please weigh in on the comments. Relendex has been heavily investing in the portfolio management side of the business, as this represents our direction of travel. I'm sure you have noticed changes to the website. No, actually it says I'm sure you've noticed that our website remains largely unchanged. I completely got that wrong. This is not neglect. We are not seeking unsophisticated retail investors. Our business is growing thanks to the loyalty of our current investors, blah, blah, blah. We're extremely grateful. The move towards a full-service model. Relendex wants to ensure that irrespective of whether you invest directly on the platform or we manage the portfolio for you, there you go, that's the Farringdon, we can provide you with the best possible service. This means we are prioritizing quality relationships, which means in turn our costs are rising per client. And sadly, certain clients are no longer viable for us. So here we go. Relendex is introducing de minimis client fees. We are proud that we have never charged our investors fees, nor are there any bid or offer spreads on a resale marketplace. For majority of clients, this is not changing. However, those clients holding less than £5,000 in loan parts will now, for the first time, be charged £25 per quarter, chargeable in arrears. Not sure what that means. Fees will be levied from the 30th of April 2025 and quarterly thereafter. This means that if fees are applicable to your account, please take action before the 30th of April to avoid being charged. And then there's some circumstances where charges will not be applied. Number one, 100% of loan parts held were not eligible for disposal on the resale market. During the quarter, your investment in loan parts is topped up to £5,000. You sell down your tradable loan parts during the quarter, leaving only the tradable, non-tradable ones in your portfolio, and you close your account within the quarter. I think fees tend to leave a bad taste in people's mouths. It's usually about scaling, right? So let's see, if you hold £4,999 on the platform, you're paying £25 a quarter. That means you're going to pay a 2% fee over the year. So 4 times a year, you're going to pay £25 fee. That's a pretty tough one if you have a small balance on a platform like Relendex. Your fees are 0.5% per quarter. If I am reading that correctly, Let's see. So yeah, if you have a balance of less than £5,000, you're going to get whacked with a 4% a year fee, which is going to make Relendex not a good place for you, I would imagine. I'm sure this is to force some of the people with smaller loan accounts off of the platform. They want probably people that have, high five figures on there. Maybe easier for them to deal with, but if you're getting charged 4% in fees, I don't think that's great. It says we do not want to lose you. We want to improve our investor service, and we very much want to see you prosper with the Relendex. This means above all else, we would be delighted to see any investor with under 5,000 on the platform, increasing your participation to the de minimis level. It talks about the portfolio, which is named Farringdon. You got to invest 25 grand to go into the Farringdon portfolio. I don't even know what Relendex's balance of loans is. Maybe they have it on their statistic sheets. Let's have a look. Goodness. Let's take a look here. Relendex. Zoom in a little bit. Where are their statistics? Give me some statistics for Relendex. Let's see, lenders. You going to show me any statistics? I don't even see a way to look at their statistics. Let's have a look. We'll have a quick look through. Grow your money with rates up to 11%. I mean, if you're getting a charge of 4% a year, sorry, it's 2% a year. I'm completely wrong on that. It's 0.5% every quarter, so 2% a year. So then, according to them, you would net out or gross out about 9% a year. Not terrible. My math is off today, but I still don't know how much of a loan portfolio Relendex actually has, because they don't seem to list it here. See if they maybe put it on the FAQ. No, it's too much to go through. That's a big FAQ. I don't feel like looking through that. But yeah, if you are a small balance holder on Relendex, just bear in mind it's going to cost you 2% a year off your gross. So think about that. Quick look at Blend's property pulse they sent out in February. This was an interesting one. Supply continues to lag behind. The Home Builders Federation recently released housing pipeline reports for Q4 of 2024, which paints a concerning picture. The number of housing projects granted planning permission fell to 2,526, 10% drop from the previous quarter and a 15% drop from the same period last year. The total number of approved residential units remains largely unchanged. This is good for, peer-to-peer lending companies, because it means, it's not good that planning permission amounts fell, but it's good that supply continues to lag behind. That's going to make demand for houses stronger, which is good for peer-to-peer lenders. It means developers are going to keep wanting to borrow money. According to the Bank of England latest money and credit stats, gross mortgage lending rose by 2.9% month on month last December to 21.4 billion. Prices growth slowed to 4.1% year on year from January. Slowed to 4.1% in January compared with 4.7% in December. So January 2024 to January 2025 looks like the house prices have softened a little bit. And then Northern Ireland house prices grew by 5.9% year on year in January, strongest of any other UK region. So our compadres over in Northern Ireland are experiencing very good growth in their house prices. So, and I think Blend still continues to do a lot of lending in Northern Ireland. Not bad. Let's look at the Trading 212 portfolio, because it follows on with a question that I got about trading. Somebody sent to me a couple of weeks ago. See how we're doing. let me, no, that's fine. So the portfolio, show me, where is it? Where's the menu? Where's the menu that, oh, here we go. I got to exit out. We are sitting right now at 28,985 pounds total. It used to give me a statistic on where we were with the pluses and minuses. I think it's up about 345%. You know, I added another 5K to this, but I want to show you the portfolio. Here we go. There we go. We're up 378%, 18,739. We're sitting on about 3,300 in cash at the moment. Here is my failed swing trade of the week at the bottom here. You can see Grab down 40 pounds, so down 12%. It was a little test trade that I did. I didn't have a lot of faith that this was going to be a very profitable trade. I was hoping it would. There was a lot of hype around Grab, the revenue that they're bringing in, but it seems like the sentiment has gone negative, although today has been a bit of a rough day in the markets, but this has been kind of sinking all week. You can see here, from Wednesday down right to this bottom, and then we had a spike here. I think this is when sentiment starts to rise a little bit, and then we took a kick in the old ghoulies this week. Everything else is going okay. MicroStrategy, again, we've seen this dip in the markets today. It was doing fine on market open this morning, and then we are down about 375 pounds, about 5% on that. The S&P Trusty 500, slow and steady, but again, this drop is happening to all of the shares today. As you can see, NVIDIA has had a nice bounce back. So over the week, we've had this nonsense DeepSeek ridiculousness that happened when all this news came out about the Chinese AI, which everybody knew was just word fodder. And then the stock bounced back from 113 up to almost 140 over the month. So doing pretty good. Yeah, back up to about 46% in the green. Amazon has been doing fine. Amazon will probably always do fine. Tesla, I've again added to this position. This has not been a particularly good one, although I'm a believer that when Tesla releases this new Model Y that's going to be coming out soon, it's going to be a huge hit. Now that's a refreshed version of their SUV, and then there is talks of a new product, a Model Q, that will be released in 2025. I think Tesla again will be fine, but we're down about 6% at the moment on that. Valco Energy just still continues to bounce up and down. It seems like when tech does well, oil does bad, and vice versa. And then Grab, of course, still not doing well. I do have a buy order in here for $318 for more Tesla shares if it does pop that low. The market certainly weren't looking good today. I was thinking maybe over the next couple of days that might actually get filled, but we'll see. But all in all, we're still doing pretty good. We're up close to 30,000 at one point here, but it just hasn't. Let's see the portfolio right here. On the 18th of February was just a hair under 30,000, so we've come back about $1,000 on it. But this goes on to the next question that I have about trading stocks that somebody had sent me, a young person. I think this is a really important email. Lawrence, just want to say thank you for all the valuable information you post. You're very welcome. I'm a relatively young investor, just started out with a new job. I've been diligently investing a percentage of my weekly pay to the Vanguard index track you recommend. I don't recommend anything, by the way. I just tell you what I do, and you guys can do whatever you feel is right. A couple of my friends have been doing some small trading amounts with stocks. They're showing me how successful they've been over the last couple of months, and it is tempting to try trading. When I look at my index tracker, it's only up about 4%, My friends have been making about 4% per month trading. My gut tells me this is not a good idea, but when I see them making money and I see my index tracker, I think that's supposed to say tracker, creeping along, my rationality feels like it is going out the window. Talk me out of trading. Ha ha ha. Cheers, Aiden, 25 years old. Really great, a great question, great email. And I think this is something that at one point in our lives we probably all suffer from, is that FOMO, that fear of missing out, seeing things go crazy, right? Seeing Nvidia stock doing really wild things, going from $12 up to, $140 and 10xing and missing out on these types of things. And I would say, Aiden, to you, hopefully you'll watch this in the future, and if you have been following me for a while, you know that I've had some pretty big fails when it comes to trying to trade anything. Now, one may look at this portfolio and say, well, you're up, 340%, right? 378%. But honestly, I think anybody could have made money in these markets. During a bull market, when the stock market is just generally going up, it's really not hard. You pick out good companies that are going to make money and that are selling or offering good products and services to the masses, and you buy those stocks and you hold on to them long term. Trading short term has its problems. Number one, if you're buying and selling stocks, you're going to get hit with short-term capital gains tax, which is a lot more punishing than long-term capital gains if you hold on to your stocks for a longer period of time. The second thing is you have to be able to withstand these emotional swings when you get it wrong. Like this grab position right here, down 12%. This is a small trade position, but if I was holding 2,000 pounds of this, that would be a 400-pound loss. That would certainly weigh on the emotions. Now, I want to show you also some of the other trades also that I tried this week with the swing trading that didn't really work out very well, and some that were okay. So let me show you right here. There was a couple here. NLS Pharmaceuticals that I bought this week. I bought it on the 10th of February. Sorry, 10 days ago. So let me show you the results on that. So that was a 30-pound loss on that trade. And here, a 31-pound loss on that trade for Patriot National Bank Corp. Another 24-pound loss on that trade for Patriot. Tempest AI was another. Actually, let me show you this Upstart. Upstart, we had a bit of a hit, 49 pounds. You can see right here on the result. Hopefully you can see that in the green down here. So 49-pound result on that. Archer Aviation, bought 323 pounds of that. Let me show you what happened with that. Sold it for a 26-pound profit. And then Tempest AI sold for a 53-pound profit. So I would imagine if I totaled all those trades up, they probably result to about zero, or either, maybe a little bit ahead or a little bit behind. Most of the time, this type of trading is a waste of time, because if you hit it on a bad day like today when the markets are just all over the place, right? Today has not been a good day for the markets. Seeing everything in red. Look at this Palantir, 7% down. Tesla 2% down. Some greens, but generally it's been a pretty red day. Look at this Walmart, the giant, down 6%. Intel, everything's predominantly down today. But if you hit these trades during a bad downturn where, maybe the S&P is down a 1.5%, or the markets are just generally going down for a few days, you're really going to get crushed on these trades. And it can become quite an addiction too. Number one, checking these portfolios too often, making irrational emotional decisions. A lot of the times when you see something down and it's falling like this, grab, stock, the tendency is to want to bail out of the trade. And you might bail out at the wrong time, like down here, and then watch it bounce back. And it's very emotionally difficult to do, and it takes a lot of time. It takes a lot of emotional drain out of yourself. It's just really not worth it. Whereas if you sit on something like this S&P 500 index tracker, whatever you want to call it, you're just not going to see those massive ups and downs, right? You're going to see small drops, small raises in one day. You're not going to have that emotional swing. I think it's just a better way to go. Trading, sure. Can you make money? Absolutely. You could get very lucky. I've gotten pretty lucky with some of these stocks, but I've also been holding them for a while. Like Nvidia, I've had it for, I don't even know when I started buying. Let's look to the first purchase. 16th of May, so 2024. So almost, 7 months, 8 months? Just been sitting on the hands and doing nothing with it, but happened to also buy in at a pretty good buying position. This was before the stock split, so $952. So I think that would be the equivalent of, I think it's split 10 to 1 if I remember. But just sitting on your hands and doing nothing, I think for nearly everybody is the right decision to make. Just because when the markets have a bloodbath period of time, which can happen, it could happen at any time, it's really hard to stomach 7, 8, 9, 10, 12, 25, 30% losses on individual stocks. So Aid and I would tell you, don't worry about what your friends are doing. There's professional traders. And also remember this too. When you trade, you're trading against another person or a computer bot. And a lot of the times you're going to be at a major disadvantage. Always remember that. It's like fighting a battle one-on-one. You're trading, okay? You're not trading against a bunch of people. You're trading against one other trader. And if you don't know what you're doing, you can really get hurt. And it can become an addiction. I've seen and heard of people and friends of mine that have gambled a lot of money on stocks and options, who've lost a lot of money. And it's not a good road to go down. And to be honest with you, I really don't even like this trading 2-1-2 portfolio. I like that it's made money, that it's, I would say, has gotten lucky for me in some ways, many ways. But I don't like checking this damn portfolio. Sometimes it gives me some stomach churns. If I was holding this thing long term and wasn't checking it all the time, I wouldn't own some of this stuff in here. I could probably own this Vanguard fund and MicroStrategy and I don't know, maybe the Amazon stock, and that would probably be it. Ideally, just this Vanguard position, maybe the MicroStrategy position, and just keep adding to it, keep buying, and just sit on it for years and years and not do anything. That would be the ideal way. I don't really like this trading, but I do it for content. I do it to try to make a little money for charity, but this is not my suggestion to anybody out there. I think it's very dangerous, and I think people can get really financially hurt. So I hope that answers your question. Go with your gut, Aiden. Don't trade. Keep adding to your index tracker, and then you're young, 25 years old. So in 25, 30 years, you're going to be very happy if you just stick to that. Another mailbag letter. Hi, Lawrence. Hope is all is well. Yes, it is. Thank you. I wanted to ask a question. I'm afraid I'm very late to the investing game, now approaching 60 years old. I'm ashamed to admit I've not been very diligent with my financial planning. I've never had a high salary, but I've always lived below my means and managed to save up a few pennies here and there. Do you have any advice to someone my age, so 60 years old, on how I could reach retirement? I currently have $80,000 saved. I'll receive a small state pension, but that type of thing could never be relied upon. Feel free to use this question for your live stream if it suits. Best wishes, Chris in Basingstoke. Thank you very much. By the way, if these letters are sensitive, I usually don't put them on the stream, but they're roundabout questions. Sometimes I'll reach out to the people that send them and just ask if it's okay if I use it, and that's why they go up on here. But this is a really great question. A lot of the times we talk about, people who have done well in life, who have a lot of money saved for retirement, but we don't tend to think about, the people that don't have a lot saved up, who maybe they got started late in life. And it's a tricky one, because when it comes to investing, time is what you have that is on your side. If you start late, I started in my early 40s, which I consider late. You start in your 20s, you're in a much better place than someone who starts in their 40s or 60s. And obviously, the older you get, the more difficult it becomes. But having said that, 80,000 is not a terrible starting place, especially if you're a frugal person and you can manage to live below your means. So if we look at a compound interest calculator, we take Chris's 80,000. Let's go ahead and put that in. Starting with initial investment 80,000, and the key is, can you add to that? So if we set an 8% interest rate for the average, maybe the average S&P 500 return on a Vanguard index tracker, and we say Chris has, he wants to retire maybe at 70 years old, so we'll give him 10 years. Let's say he can put away another £300 monthly. We'll see where he's at. So there you go. Look at that. 10 years. He'll end up with approximately £232,000, £232,455. Just putting in £300 monthly. So now he's going to be taking quite a bit of risk at an 8% interest rate, because the older you get, the less risk you want to take. If you're 100% in stocks and shares when you're in your 60s, you are taking significantly more risk. Now, I don't know what that person's living expenses are like, but I'm going to presume they're mediocre and they're living, Chris is living below his means. But if he can stomach taking a risk of putting 100% into his index tracker and not doing any fixed income, he could certainly get to 232,000. And if you're drawing down about 4% of that a year, or 5% of that a year, which is 10 grand, that's going to last you through retirement, hopefully. If you can add to that deposit amount £300 to say £500, that's going to make quite a big difference too. So that gets you to 270,000. So obviously, the more money that Chris can put into this investment, even at 60, the better off he's going to be. If you can get somewhere in the range of $1,000 a month, which is, again, this is a stretch for some people if you're not on a high salary, but maybe finding other ways to earn income, sell things. You can do little side gigs to get to that $1,000 a month. But now you're looking at 360. That's a pretty big number, starting from 60 years old with an £80,000 start. So, it's definitely a bright opportunity for him, and certainly not as dire, Chris, as you may think it is. Again, you've really got to focus on putting away as much of this monthly investment amount as you can if you're comfortable taking a risk that might get you 8%. Now, if we move that number down to 6, which would be more like a fixed income and equities, you're going to be looking at about 309,000, putting away $1,000 a month. It's going to be less, obviously. 500 a month will get you to 277,000. So even that, with a mixed risk portfolio of 6% annually, is still going to get you, £227,000 at retirement of age 70. So that's what I would do. I would just tell you to put away as much as you can. It's never too late to start. I know people have started in their late 60s and have managed to just keep going and get to about 80 years old and have enough saved up. Is it ideal? No, of course it's not. Ideally, we would all be smart. We all started investing when we were 20 years old and be multimillionaires now, but the best of us don't do that. So your circumstances are what they are. But I hope that answers the question. Think about risk. How much risk are you willing to take? If you're a risk-on person, you can bang it all in an index tracker. That's what I would do. You might get 8%, you might get 10, you might get 12. Over the last couple of years, we've been averaging in the mid 20%. So that portfolio would probably do very well. But if we have down years, you might get 3% one year or 4% one year. So again, think about what your risk is like, and you want some kind of a fixed income product that might pay you 4 or 5%, even just savings cash, or put some in a loan pad. It's easy money. It's going to get you like a fixed income rate of 4.5% to 6.5%, 6.3%, and then balance it out with your index tracker. Let's see what else we got. What time is it? Oh gosh, we've been going 45 minutes. I checked out the consumer CPI rates for the UK. We had CPI, so inflation has been increasing, and this is kind of what I've been saying over the last year, that I don't think inflation is under control in any way. December of 2024 is a 3.5% increase from a year before that. In January, 3.9%. So prices are going up. And this is not a good sign for the economy, because everything was, the governments were saying, oh, we're going to get down to 2%. And I've always said, I don't think 2% is possible anymore. I think 3.5% to 4% is the norm. But the problem is the expectations of people are now 2% inflation. This is why it's good to invest in things that are inflationary hedges to try to beat. You've really got to beat this 3.9% rate with your investments now. Otherwise, cash is getting eaten away by inflation. The problem is we've had cuts in interest rates. So Bank of England cut its interest rate recently, which is really surprising to me. I think it went down to like a 0.25% rate cut, which I can't believe is happening when inflation is going up. Happening too in the U.S. We had the CPI in the U.S. continue to go up, 0.5% increase in January, so now it's back to 3% in the U.S. It's not where the U.S. wants to be. I personally, I think inflation is way more than what we're being reported, because the media reports weird things to us. Now we've found out this may not be accurate at all. Even this U.S. Labor Bureau of Statistics, can we trust that information? I'm not so certain. Look at the price of eggs. This is in the UK. Egg prices up by almost 20% since the start of the year, with more rises to come. Also happening in the USA. US egg prices hit a record high of $4.9, so $4.95, which is crazy. I remember you used to be able to buy eggs for just a few months ago to $2.50. So we've had almost, I think, 50% increases, and that's just a basic thing that most people eat, and it's just going to show you how inflation is happening, and that they blame this on bird flu and blah blah blah. I don't think it's anything to do with that. I think it's just inflation happening, and that's what's going on. I got another email too. I'm not going to put this up on stream because I don't want to show the person's name, but it was kind of an emotional email. It said, "Hi Lawrence, going through a difficult time, likely to have to file bankruptcy soon due to a divorce and some bad financial decisions. My situation has been a big emotional drain, but through all the troubled times, the weekly online show has been a place of relief. I like the community you've built, so I wanted to say a big thank you, and I hope you keep it going." Look, a big shout to you guys out there. This is the community that this person is speaking of. The fact that you guys come together and talk about finances in the chat, and you come and share your experiences, you are helping other people out there. And I don't know if I've ever mentioned this, but I've been through difficult times in my life. To be fully transparent, 2000 2008, I went actually not 2008, 2000, between the period of 2003 and 2008, I went very heavily into real estate investing. And I had a decent sized property portfolio that was about 50% leveraged. By the time that the property market crashed in 2009, coming up to 2010, I was having a really, really difficult time keeping up with those payments. And I'd only leveraged the property portfolio about 50%. So I'd put 50% of my own cash into all of these properties and land. I was planning on building things. And even with a 50% leveraged loan to value, I was still struggling to make those payments at the end of 2009, beginning of 2010. I just couldn't do it anymore. And unfortunately, I had to file for a bankruptcy at that point. I lost all of that real estate, all of that cash that had been put into those properties. And I can just really relate to that email, because looking back now, 13, 14 years later, life has certainly improved. But back then in 2010, when that bankruptcy was filed, it was a really, really difficult time for me. Emotionally, I just felt like nothing was ever going to get better. I'd lost everything that I'd worked most of my life for, taking risk. I didn't think I had that much risk on the table because I was only 50% leverage. That turned out to be a big learning lesson about risk management and not taking too much debt, for sure, and having the ability to pay off the debt if the worst happened. And at the time, I didn't have the ability to pay off that debt. It was hundreds of thousands of pounds. And it was a rough time. So my heart goes out to the person that wrote this letter, especially going through a divorce too. And that's probably two of the worst things that you could, go through at the same time. And it does really make you have perspective about what's important in life. Money is certainly not everything. I was unfortunately got the news that a friend of mine had passed away a couple of weeks ago. He was 57 years young, and he had really squirreled away his money for a long time to get to this point of retirement that he had just hit in his early 50s. He had done very well for himself. And he was just about to move into a new house actually this week. And unfortunately, he's no longer with us. But it just really made me think about perspective and how we chase after money. And there is no guarantee that tomorrow comes. So I think it's important to, not to take too many risks, but also to enjoy life. If you've been fortunate enough to make money in your lifetime, I think it's important to enjoy that money in some ways, being responsible, of course. But just squirreling away money and watching this bank account number go up and up and up is it really the best thing in life? Yes, if you have a purpose and you have people that you want to leave your assets to, great. But I don't think it's a good idea to think that way 100%. I think it's important to enjoy the fruits of your labor. Treat yourself, if you can afford to do so. But yeah, my heart goes out to that person if you're watching. Keep coming back. Things will get better, I promise you, because it did for many people I know actually filed bankruptcy during that rough economic time in 2008. Several friends of mine had the same problems in real estate. And they're in a much better position now, so I know things will get better for you. Keep your chin up. And I saw this nice tweet from a guy named Joey Swall, who is a bodybuilder who lives in Canada, and he said 10 signs you're doing well in life. Number 1, you have a roof over your head. Number 2, you ate today. 3, you have a good heart. 4, you care for others. 5, you have clean water. 6, someone loves you. 7, you tried to do better. 8, you have clean clothes. 9, you have dreams. And number 10, most important one, number 10, you're breathing. I thought that was great. So that's a good thing to read. Probably a good thing to bookmark and when things are not going well. because we all have our down times in life. You know, if anybody tells you that they don't have any down times in life, they're just lying to you. So we all have our ups and downs. Let's do a bit of quick crypto news and we're going to get out of here. Look at this. Top British bank Barclays reports 131 million pounds of exposure to BlackRock's Bitcoin ETF, which you still can't buy in the UK. But, of course, Barclays has access to things that regular retail investors don't. I mean, this is a really small part of Barclays' investment total portfolio, but it's an interesting one. They have 2,473 shares of the BlackRock fund. That shows institutional exposure to Bitcoin. Investors piled $38.7 billion US dollars into Bitcoin ETFs, 3 times more than the previous quarters. So a lot of money going. And this is quarter 4 of 2024. Just one quarter, $38.75 billion going into Bitcoin ETFs in the US. Major funds like Wisconsin's Pension Board and Paul Tudor Jones's hedge fund significantly boosted their Bitcoin ETFs stakes. And BlackRock's iShares Bitcoin Trust now has over 1,100 institutional holders, a potential record for the first year of an ETF. Bitcoin is holding its price well even during this stock market meltdown, sitting right now $97,947. So it's really uncoupled itself from the stock market, at least this week. So holding steady. Who knows what the future brings? We will find out, though, for sure. Anyway, that is all that I have for you today. I hope that you enjoyed the stream. Have a quick look. Oh, buffering. No, really, we're buffering so much for the new computer. We need more juice. Yeah, you know what I think the problem is? Because I'm on Wi-Fi. Oh, yes. I didn't realize I've got my... I have my computer set to Wi-Fi. I should have turned the Wi-Fi off. That's why it's buffering. Sorry about that. I'll remember to turn that. I was thinking before I went on the stream, I need to turn the Wi-Fi off, and I didn't do it. Anyway, let's see. 10% is high for property. I need a treadmill I can use to keep it powered. Yeah, I could. That's not the computer's fault. This is just the internet. Good evening, George Batchelor from a wet Bridlington. Dave Dawson getting disheartened with crowd property. Can't be mad about that. Yeah, I think you're right. Surely with such a good growth driven government, everything should be rosy. You know, it's funny, right? You say that because look at everything that Mr. Trump promised. Everything was going to get better economically. Things will get cheaper. The eggs are not cheaper. Stephen Hale, hi from Nottingham. Bit late. We'll catch up. Yes, welcome. Paul News says, Rolls Royce has been good to me. Good for you. Okay. Most private traders lose money statistically. You're absolutely right. If you're trading, you should be using options to use leverage. Options are really, really risky. I have done some options trades recently, and they have not worked out well at all. Dave says, Dave Dawson, our guy who asked about the £80,000 pension and blah, 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 he should set up a personal pension and get his tax back and put as much as allowed. You can go back 3 years, so normally quite a bit can be put in. Okay, a great suggestion. If he could get the whole 80,000, he would get a 25% uplift. Good suggestion. Rates are being cut in order to stimulate the economy, trying to walk a fine line. Yes, we've all made big financial mistakes in our lives. Absolutely. A big thumbs up to you for saying that, because that's certainly true. Anyway, that is all I've got for you this week. I'm not sure whether I'll be back next Thursday or next Saturday. Probably Saturday, but keep an eye on the email for the notification of when the next stream will be. Thank you to everybody who supported the stream and for joining. And yeah, that's all I got. I will absolutely see you next week. Hopefully, right? Hope so. That's the goal, is to be back every week, but sometimes that doesn't happen. Anyway, thanks for joining. Much love to everybody. I'll see you next time. Take care.